Hi guys, let's look at the Forex market and try to understand in a bit more detail what this market is all about and how we can use this for trading. Now, if you go to Google and search for the foreign exchange market and open the Wikipedia page, this is the article that comes up. So I'd like you to start with reading this article so that you get a good idea about the introduction to the Forex market, who are the main, how it came about, what was the history for it of the market, what is the size of the market, who are the major players, main participants, different currency pairs that are part of this market, as well as the fundamental reasons why the price moves. Moving on to what are the different financial instruments that can be traded under the forex market, starting from the spot market. You have the forward contracts, you have the swap, you have futures, and you have options, all specifically designed for the forex or the currency market, or also called as a foreign exchange market. Now let's start with understanding the size of this market, because that is what makes it very attractive. As of April 2019, the size of the foreign exchange market was $6.6 trillion, which means this is the amount of transaction that is happening on a single day. This is the value of the currency that is exchanging hands on a single day in the foreign exchange market, which shows that this would be and this is an extremely volatile, not just volatile, it is extremely liquid, more than volatile. It's volatile on certain days, but since it's controlled by the governments, it's not as volatile. However, because of leverage, even the small movement reflects into a huge profit or loss. So we'll talk about that in a bit more detail. But first, few features about the market is, first of all, it has extremely high liquidity, which means you will always get a buyer or a seller at any price that you wish to buy or sell. That's what liquidity means. So there's always a buyer or a seller available at any price. It is a 24-hour market except on weekends. It starts from Sydney and moves on to New York. Okay, we look at that as well. These are the few main features, and it has a huge amount of leverage that is provided. That means good margins are given in this market by the brokers. So let's try and understand firstly what this forex market is all about and how the trading works on this market. Let's say we talk about USD INR right now. So currently, as of today, the price of USD INR is 75.03, which is about, let's say, for the sake of simplicity, 75 rupees is the current value of 1 USD. And as you see, the immediate high that we see here is around 76.5. So let's say we are expecting the price of this instrument USD INR to reach 76.5 in about, say, 1 or 2 weeks time, which is just the next high. Okay, so that's what we are expecting to happen on USD INR. Now let's say we go to a money changer, and currently at the price of 75 we buy 1000 USD. So we would need 75,000 INR, with which we'll be able to purchase 1000 US dollars. Now we gave the money to the broker, or say a money changer. We give him cash 75,000 rupees. In return for that, we get $1,000 note. We have this note, and we wait for the price to go up to this particular high. Now let's say 2 weeks later, price has reached 76.5. Okay, now what happens to our 1000 USD? This 1000 USD will now we will go back and return this 1000 USD to the broker, and in return for it, how much are we going to get back? So since the rate is at 76.5, we are going to get 76,500 INR back in return for $1,000. So what happened here in this particular transaction? We made a profit of 1,500 INR. It could have been a loss as well, but just in case, in this case, price has gone up in our favor. So we made a profit of 1,500 INR. Okay, this is exactly what happens in a forex transaction or forex trading. We buy a currency, we expect it to go in our direction, and we book the profit or loss, whatever the case may be. Now, if you do the same transaction with a slightly higher amount, which means in this case we were trading with 1000 USD, but when we talk about the foreign exchange market or the forex market, you have a lot size. As per calculation, one lot size is the value of one lot size is always equal to 100,000 USD, which means one lot is always 100,000 US dollars. That means in our case, when we would buying 75,000 INR worth of currency, we got $1,000, we would have ideally taken the trade with a value of 75 lakh rupees, right? So after 70,000, what we're doing is we have 75,000 and add 2 more zeros to that, that is 75 lakh rupees. That is equal to one lot, because the value is 100,000 US dollars, right? So in INR, it's 75 lakh rupees. So if you had taken the same trade with one lot or with 75 lakh rupees, how much would be your profit or loss? In this case, instead of making a profit of 1500 rupees, we would then make a profit of 1500 times 100, which is 1,50,000 rupees. Okay, so all we've done is the same transaction, but with the slight difference that instead of trading with $1,000, we are trading with 100,000 US dollars. So this 100,000 US dollars is called as the lot size. This is a lot size of a forex transaction. So whenever you're taking a trade, it will be in multiples of one lot or in a fraction of one lot. So you also get half lot, you get 1/10 of a lot, which is called as a mini lot, and you also get micro lot. So we'll look at that a bit later. But in general, this is what we are doing when we are doing forex trading. We are expecting the value of a currency with which it is paired to either increase or reduce, and that would be our bet, right? So that's in general how forex trading works. Now let's take another example of a different currency pair, which is one of the most popular currency pairs in the world, which is Euro USD. Okay, so in this case, if we say that 1 Euro USD is equal to 1.11477, this simply means that €1 is equal to 1.15245 USD. Okay, so €1 is equal to 1.15 US dollars, which means obviously the value of the euro is slightly stronger than the value of the dollar. Okay, if you are expecting euro to get weaker, you can go short. If you are expecting euro to go be stronger, you can go long. So if you're expecting the price to fall further down, we would go short here. If you expect the price to go further up, then or reverse from here and go back up, then we would go long. So that's how you'd be actually taking a trade. But here the important point is to look at these digits. Okay, €1 is 1.15245. So there are 5 digits after the decimal. So the particular digit that we are interested in is the 4th place of the decimal. That is 1.1524. The 5th digit, or that number 5, is called as a point, and the 4th digit is called as a pip. So 1.1524, when this moves to 1.1525, that is called as a movement of 1 pip. Okay, and then once 1.1525 moves to 1.15246, this is called as a movement of 1 point. So as you can guess, 1 pip is equal to 10 points. So for our purposes of calculation, we always refer to currency pairs in terms of a pip movement, which means we focus on the fourth place of the decimal. We kind of ignore the fifth place because the fifth place is generally used when you're trading with very, very small amounts of value, like a micro pip or the fifth place of decimal is used with, is generally not considered as a huge amount to discuss. So when you say market fell certain amount of value, you would normally say if the market falls, say from 1.1340 to 1.1240, so we have 1340, let's say it falls to 1.1240, this is called as 100 pips. So if you see on the right hand side, it says 102, it says right now 99.7 or 102.8, right? So what it's doing is it is telling you the value in pips. The fourth place of decimal is what you can see in terms of the calculation. So this is a movement of 100 pips. Now if you move to the daily chart, let's see on an average how many pips does Euro USD move in one day, on a big day and on a small day. So here let's see, we have a big Marubozu candle. So we are just going to measure how much was the movement. So that movement will be the fourth place of decimal. That's 1.1594 and 1.1478. So just take the measuring tool. As you can see, this is a movement of 116. That 116 means the fourth place of decimal, which is 116. So that's called as 116 pips. PIPS, pips, 116 pips. So the fourth place of decimal is called as a pip. If you look at this again a bit later on a different day, let's say on a day, okay, the last day that we see here, a big candle, here it moved about 94 pips. And then the day after that, where we have small amount of movement, just a doji candlestick, here it moved about 50 pips, half of what it actually moves on a big day, right? So you always measure the movement of this currencies in terms of pips. We don't look at the fifth. You already know the fifth digit, but when you are referring to the movement, it is referred in terms of a pip. Now this is normally used for all currency pairs except when you go to the Japanese yens. Okay, so when we are talking about the Japanese yen, we will refer to the second place after decimal. Now if you see on the right hand side, the price is given in pips and the fifth decimal is given as a much smaller, as a smaller number here, right? So so it is 115.19. this is the price in pips. There's the value of the currency, and then we have the four on top. The small digit is the fifth, is the point. Okay, so we always look at the fourth place. So the important number is the first floor, which is the pip movement. So as per the first four on this day, which was the last day, Euro CAD moved about 0037, right? 37 pips. Here it moved 96 pips. When you talk about currency pairs like Euro JPY, it moved about 12 pips. Okay, so for a Japanese yen, all the currencies will have JPY in the end. We look at the second place after decimal, and for everything else, all the other currencies we look at the fourth place of decimal. Now here if you see GBP USD, Great Britain pound against the US dollar, it has moved 79 pips on this big red candlestick, just from open to close. And if you wanted to see the whole day, the range of the entire day, then you check it from high to low. So you see from high to low, it has moved about 110 pips. If we see Japanese yen with a Great Britain pound, this is GBP JPY. On this big day, it has moved about 124 pips. There are some days which it has given a movement of about, say, 205 pips, right? So you can see this currency moves a lot more. So if you see on this particular day, we saw the movement of about 310 pips. Okay, so this is called as pip. This is how you measure the pip. Pip is generally the value in which we measure the movement of a currency pair. Now the next thing is about the hierarchy of the market. So we're going to understand the hierarchy of the market here by looking at who are the major players in this market and what is it that they're doing. Where are they in terms of the chain? So we're going to do it in a top-down approach. Right on the top, you have the major banks. Okay, so when I say major banks, we're talking about the central banks like the RBI, the Federal Reserve, the Bank of England, Bank of Japan. All central banks are right at the top of the chain. Below the central banks are the prime brokers, known as, these are called as the prime brokers, which are the biggest financial institutions or the banks in the world. For example, you have Citibank, you have Goldman Sachs, you have JP Morgan. Alright, so these are the biggest financial institutions in the world. These are called as prime brokers. Below them are medium-sized and small-sized banks like, let's say, HDFC, ICICI, smaller banks, and hedge funds come right below this. So below this you will have hedge funds, below this, along with hedge funds, you will also have the brokers like, say, Upstocks, Fidelis Capital, FX Pro. Different brokers come at this level, big and small size brokers. You have commercial institutes, companies, and right below this are the retail investors or retail traders, that is you and me. Okay, so this is the chain. This is how the market functions. When I say this is how the market functions, it simply means that you have the a retail trader wants to buy the currency. So let's say I expect that the price of GBP JPY currency pair, that is the pound against the Japanese yen, is going to be bearish and it is going to be touching this level very soon. So I'm expecting the price to start to fall to this particular low. That means I have a bearish view. Now I would like to go and short this currency. Okay, I would like to go short on this currency, but where do I get this currency? So I'm here, I'm the retail trader. I would place a order with my broker. My broker is going to get his order from a medium-sized bank. This medium-sized bank is going to get his order from a prime broker, and this prime broker is going to get the order from the central bank. So this is how the chain works. All right. Obviously, right now I'm at the bottom. To make this transaction, I have to pay something. All these people are going to benefit by my trade, which means there will be some amount of commission that this guy will charge me, and from that he has to pay a certain amount of commission to the guy above him. Same thing with the prime broker, and then same. So this guy gets some share from my brokerage, my commission. Some part of it goes to this guy, some below him, some below this, and then finally I get. Now, since the guy on the top, the major central bank, has the maximum volume, because all over the world all the orders will be placed through the central banks, they will keep the smallest percentage of the commission because the volume is big. All right, and the largest percentage of the commission will be kept by this guy here, which is our broker. So this is how the order flows between different institutions for us to get our trade. So the major central bank, since all the prime brokers are connected to the major banks, if I want to buy this currency pair, or if I want to sell this currency pair, there would be millions of other people who would also want to say buy this at this particular time, at this particular price. So through this chain, because of this network, the price is matched and buying and selling is facilitated. All right, so the broker helps in doing this because everyone is trading this market. There's extreme amounts of liquidity. Somebody somewhere at some part of the world at any time is always looking to buy or sell this currency pair, and most other ones as well. Okay, so you can always get your entry exit through this chain. Now this network is not regulated by a single institution like National Stock Exchange, or any other stock exchange like New York Stock Exchange or anything. It is a over the counter market, or also known as the OTC market. So OTC market, what it does is, it is just a network. Anyone can get into this network, start a broker, become a broker, take the feed from, pass their orders to the bank higher above them. They can pass them orders to the broker above them and be part of this network, because of which you have regulated brokers and unregulated brokers. All right, so that's where the risk of this market comes in, where there are some people who do not have any licenses, because there's nobody regulating this market. So you get unregulated brokers, and there are some brokers who have a license, which means just like we have the SEBI in India, we have, say, Australian Securities Commission in Australia. You have different authorities in different countries. These authorities are going to regulate certain brokers in terms of forex trading. So they will get a license and become a licensed broker. Then you have unregulated brokers who can just, let's say I decide to become a broker who's not regulated. I can talk to about, say, 20, 30, 50, maybe 100 people and say that you can, whenever you want to buy a currency, you let me know. I'm going to provide you the order, and I'll pass it on to the guy above me, right? So I can also become broker at any point. So that's what it is. That's the point about the forex market, where anybody can get in and start this whole transaction business. But the point is, there are also regulated brokers who do this, who have certain rules to follow, who will be audited by a bigger authority and all of that. So one thing is, about whenever we trade in the forex market, we need to always find a broker which is regulated, which has a license. And all forex brokers who have a license will display the license on their website with the number of their, with the exchange that is regulating them, along with the license number. So this is one thing that everyone needs to be careful about when selecting a forex broker. Now the next thing to talk about is our 24-hour market. Since this market is for everyone, major central banks across the globe, if you come onto this particular site here, it very clearly shows how the forex is a 24-hour market. You see here. Now today is a Sunday. Tomorrow morning at 3:30 a.m. my time, the trading is going to start from Sydney, Australia. Australian markets will open. Australian Central Bank will open. Traders will start punching orders from Australia, and the market will start to move. No matter which currency it is, all the currencies will start to move. So the market will open at 3:30 a.m. our time. A little later, after 2 hours, the Tokyo markets are going to open. So Tokyo Stock Exchange opens, Tokyo traders come in, they start to trade. Even the currency market, demand and supply starts to move, and then you'll see more volatility, more liquidity in the market, because Japanese market would be open. Further on, at about 1:30 p.m. our time, the London markets open. So there is a slight overlap between the close of the Tokyo market and the open of the London market. You can see here, Tokyo market is closing at 2:30, London market opens at 1:30. So for 1 hour, there are these two markets which are overlapping. So obviously this 1 hour, there will be a lot of movement in the market. As we move further on from the London market, in the evening 6:30 p.m, the New York market starts to open. So New York traders come in. There's a good amount of time from 6:30 p.m. till about 10:30 p.m. that both London and New York are open at the same time for 4 hours in the evening. This is the time you see maximum volatility in the forex market, the global market, because we have two big markets open at the same time. Now, at 3:30 a.m. the New York market will close, and immediately at 3:30 a.m. the Sydney market will open. So because of this, Forex market becomes a 24-hour market, 24 hours except for the weekends. Weekends the markets are closed. Because of this, whenever you exchange physical currency on a weekend, you will always get a high price because the markets are closed. So whenever you're traveling or you need currency, you should be doing it in the middle of the week or the start of the week, not on the weekend, because the price is going to be bad. Now we'll talk about another concept which will make a difference when we take a trade. So let's say I want to go ahead and take a trade on Euro USD. Current price is 1.1147. You can see 1147 with a micro pip of 7 again. Let's say I want to place an order. Now if you come here, you can see let's say it's a market order. Quantity right now is 100,000. That means this is one lot. And we see here the difference between 1147 and 1149. Okay, that's about two pips. But there is a micro pip. So 11477 and 11490. Okay, so basically, if you divide this, if you subtract this 90 minus 77, you get 13. So that's 1.3 pips or 13 points. This difference between the buying price and the selling price that we see on the screen, this difference is known as the spread. So I'll just write this down so everyone knows what we're talking about. The spread is the difference between the buying price and the selling price. This difference of 1.3 pips or 13 points, in general 1.3 pips is the spread. That means if you're trying to buy this currency pair, you are going to be paying 11490. If you're going to short this currency pair, you're going to be getting it at 1147. Okay, so this is nothing but bid and ask. This is your bid price, this is your ask price. This difference of 1.3 pips is called as a spread. This is the amount, this is the money, the brokerage or the commission. This is what you pay for your transaction. So this 1.3 pips multiplied by your volume. Okay, this 1.3 pip is going to get distributed between your broker, the broker above him, the broker above him, and the central bank. Okay, so they're going to divide this. This is what we pay to do this transaction. Now the question is, how much money do we make when this movement happens, right? So if the price moves from let's say we go short at 1147. So our short is at 1.1147. Our quantity is say 100,000. Okay, because that is equal to one lot. So let's say we have taken a short of one lot which is about 100,000 USD. Okay, I think it's 1147, not 41. Now as the market moves from this 1147 in our favor, let's say it goes to 1146, just one pip down. So price comes to 1.1146. This is the movement of one pip in our favor. Now we need to decide we need to know how much money did we make in this case. So that is equal to, so we made one pip, which is 0.0001, and this we multiply with the lot size, which is 100,000, which is equal to 10. Okay, so if the market moves in our favor by 1 pip, we make 10 US dollars of profit with a volume of 1 lot, when a quantity of 1 lot. So let's understand this a little better. We go back here. You can see here the quantity says 100,000, right? So if we go sell this at 100,000, and if we put a target of 1146, this means we are going to be making a profit of $10. It says 1 pip. Okay, so 1 pip is $10. That's what you have to understand in this particular case. Now there are different currency pairs, and it is not equal to $10 for all the currency pairs. For GBP USD, which is pound against dollar, it is $10 for 1 pip for 100,000 US dollars. It is the same for Euro USD. But when you talk about, say, New Zealand USD, Australian dollar, USD Japanese yen, USD Canadian dollar, it will change. So it changes from about 1 pip is equal to $7 or $6.5 to 1 pip equals to about $14. Okay, how you would know? Simple way to do it is because this will depend on the currency price, value of the currency as well. So simple way of doing that is just go to Forex pip calculator. A good one that I normally use is from FX Pro. So let's see how to use this calculator. Now once you come here, it gives you the currency pair. Just disable all this, and it's asking you whether you want what currency. So always make this USD. So for Euro USD, for $100,000, 1 pip value is equal to 10. 1 pip is equal to $10. If you move this to, say, GBP Japanese yen, for $100,000, 1 pip is equal to 8.67. Okay, so if the market moves 1 pip in our favor or against us, we are going to lose $8.67 for a volume of 1 lot or 100,000 USD. For GBP JPY. Okay, same way if you look at, say, USD Canadian dollar. So let's see how much is that. USD Canadian dollar, account currency USD, size unit is 1 lot, which is 100,000 USD. The pip value is 7.83. Okay, now this pip value will change as the value of the currency changes, but in general you can keep it constant for at least a month. So you can have an Excel sheet where you can update all the pip values once a month, because they're not going to change too much. Okay, so it's not like today it will be 7.8 and after a week it's going to be at 10. It will be just marginal changes. So you can update your pip value in your Excel once in a month. That's more than enough. Okay, now what we have seen till now is all in the lot size of 100,000 USD. Okay, now there is a concept of leverage which is provided by all the brokers, and a huge amount of leverage. So leverage simply means that, see, for trading 1 lot, you need a margin of 100,000 US dollars, right? Instead of taking a margin of 100,000 US dollars, it's not like everyone has 100,000 US dollars, especially the retail investors, to be able to take 1 lot of volume. So what we do is, what the broker says is, they are going to give us a leverage. So leverage basically means margin. Okay, now if the leverage is equal to 100, that means 1:100. If there's a leverage of 100, That simply means instead of putting up 100,000 USD, for the same amount, for the same quantity which is worth 100,000 USD, you would have to put up 1000 USD with a leverage of 1:100. Okay, so you have $1,000 in the account, you can go and purchase currency worth 100,000 USD. That is what it means with a leverage of 1:100. If you change that to say 1:500, then it means for the same 100,000 USD, you need to pay $200. You need to have $200 in your account as margin to be able to trade currency worth 100,000 US dollars. All right. So if it goes in your, but one pip movement is still going to be $10 in case of Euro USD. So if it goes in your favor, by say 20 points, 20 pips into one lot is $10, so that would be $200 of profit. That means this 200 can become 400. If it goes against you by 20 pips, that means your 200 is gone, you will be out of the market, your account is wiped out. So we normally do not take the entire one lot when we trade. You have options to, you can take, instead of 100,000 USD, which is equal to one lot, you can take say 10,000 USD worth of currency, which is equal to one mini lot, which means one pip movement will be equal to 1 USD. Whereas for a standard lot, or one lot is also called as standard lot, for one lot one pip movement is equal to $10. For a mini lot, one pip movement is equal to $1. And for a micro lot, which is equal to 1000 USD, this is called as a one micro lot, which means one pip movement will be equal to 10 cents or 0.1 USD. So if you were to go ahead and take this trade here, instead of keeping a quantity of 100,000, you can keep 1/10 of that, which means you can keep 10,000 as your quantity, or you can keep even 1,000 as your quantity, which means a micro lot. So that flexibility is given. If you are going to trade for a micro lot, which means 1,000 units, 1,000 USD worth of currency, in this case, with a leverage of 1:500. Okay, so you're going to take the same example. Instead of taking 100,000 US dollars, we are going to trade with say 1000 US dollars, which is equal to 0.1 lot, or also known as a micro lot. Now what we are trying to do is we are trying to calculate how much margin will be required to take this trade. Basically to buy 1000 USD with a leverage of 500. So you just do 1000 divided by 500, which is 2. So with $2 you can buy currency worth $2 in your account. You can buy currency worth 1000 US dollars, which will give you one pip movement. I'm sorry, this is not 0.1, this is 0.01. One lot is 100,000, 0.1 lot is 10,000, and 0.01 lot is 1000. Okay, so it's the size will be this is called as a micro lot, which is worth 1000 USD. Now one pip movement for a standard lot or one lot, one pip movement is generally $10. For a mini lot, one pip movement is equal to $1, and for a micro lot, one pip movement is equal to 0.1 USD. All right. So when we come back to the trade settings, If your quantity is 1000, that means you are trading with a micro lot, which means 1 pip movement will be equal to 10 cents. So once you go to the Forex calculator as well, here you can specify. So this is for one whole lot. If you're trading with 10,000, that means 0.1 lot or a mini lot. Okay, so it's not going to calculate it for less than 100,000. Okay, here it is. 0.07 is the 1 pip movement when you're trading with a micro lot. When you're trading with a, okay, sorry, I think we just had to refresh it. So when you're doing your pip value calculation, I normally do it for 100,000 because I know for one lot how much it is. It is going to be 7.8. So then obviously for a micro lot it's 0.78, and for a mini lot it is 0.78, and for a micro lot it is 0.07. Okay, so that already done. So in the Forex calculator, if you're calculating the value, just do it for one full lot itself. But you need to know this so that you understand what you're doing, how much size we are talking about. Okay, standard lot is one lot. Standard lot is one lot equal to $100,000, but you can trade with micro or mini as well. That's the benefit, and you have a huge leverage of 1:500, ranging from 1:50 to about 1:500, which means that is the margin that is blocked. So that gives you a brief introduction to the Forex market. There is more that you need to learn about the currency pairs, the major currency pairs, the minor currency pairs, and all of that we will be discussing in our next video. Thank you.